So initially when I stumbled across ICT, I'd watched tons of videos. I'd watched the 2022 mentorship, I'd watched the 2016 mentorship, but I quickly came to realize there wasn't really a resource or a utility that I could use and pick up and learn daily bias well. Okay, and that was actually due to two reasons. First of all, daily bias can't really be taught. Okay, in this video, I'm going to give you 7 to 8 tips that I believe will put you on your way towards actually being able to learn and dissect daily bias, but it isn't something that you can just sort of acquire, right? It's something that you're going to have to put the work in and something that you're going to have to study over a period of time. Number two is because ICT gives you everything, okay? He doesn't give it to you all connected. He gives it to you in steps and essentially puzzle pieces, okay, that you're essentially required to systemize and strategize and pull together. So I looked across the internet right at the time and I thought to myself, cool, let me see if there's any decent daily bias videos. And there were daily bias videos available, but a lot of them were either pattern trading or they were misleading videos, right? So a couple weeks ago, after reflecting about my journey with daily bias, I thought to myself, look, let me create a utility or a video that people could come back to, watch, absorb a piece of content, and then actually go away and have the necessary steps slash method in order to learn daily bias and decode it themselves. So the content of this lecture, right, we're looking at why you want to learn daily bias, and then I'm going to go into numerous ideas around market functions, PCH, PCL, Orderflow, Invalidation, so etc, right? Now make sure you stick around till the end because I'm going to give out a free Notion template where you can actually go ahead and practice daily bias, because as I mentioned at the start, that is the only way to get good at daily bias. You have to practice. And I think that's another thing that's not normally stressed. A lot of these guys online are sort of just showing these ridiculous sort of patterns and saying, oh, if this candle forms like this, then the next candle is going to form like that. And it's a very naive, sort of boxed in, myopic approach to daily bias, which doesn't work in the long term. So why daily bias, right? So daily bias does all the heavy lifting for you, okay? It provides a framework for your trades. Once you can accurately predict daily bias, then you can be on side, and essentially you just have to focus trading in one direction. It keeps everything very, very simple. The variables are easy to control, and it's just a great way to trade. Okay, your aim as a daily bias trader is to forecast the expansion of the next daily candle. So in case you didn't understand what I meant by daily bias, that's how I define it. Okay, now you can take that information and you can apply it to any time frame, the weekly, the monthly, the hourly, right? You can use that information that you learn in this lecture and you can apply it everywhere else. Okay, now a key thing here, and again, I don't think this is really stressed enough, right? Daily bias requires critical thinking. Initially, it is not easy at all, but once you can do it consistently, you can build the confidence to be able to do it over and over again. Okay, and that's what your key is from this video. And then the main takeaway is you want to be able to watch this video, learn some techniques, and then go away and be able to form daily bias on your own. So let's have a look, right? So number one is market functions. So we must understand that the market only ever does two things, okay? It either rebalances fair value or it seeks liquidity. Now, what does this look like? Well, we have on the left a fair value gap, and we have on the right the idea of buy side and sell side liquidity. So simply put, the market only ever wants to do one of these two things. It's either going to go and revisit some sort of fair value, or it's going to go and try to reach some sort of buy side liquidity or sell side liquidity. Now, the reason I put this first is to really hit home and understand that every single drawn liquidity, which what that basically means is like where I'm expecting the market to gravitate towards, will always be either an FEG or some sort of liquidity. Okay. Now, a little secret tip that you can use is if you actually combine these two ideas together, you will have a really, really high probability drawn liquidity. Okay. So if you combine the idea of a fair value gap, underneath an old low or above an old high, those are the drawn liquidities that I prefer to look for majority of the time, okay, as they're the most high probability draws in my personal opinion. Okay, so this is an example. So for example, let's just say you were looking for the drawn liquidity to be bullish or not bullish, sorry, above market price, then you'd look for some sort of buy side liquidity, and you'd look to couple that with a fair value gap above price. Okay, and vice versa. Let's say you thought price was going to roll over and take the sell side, we'd look ideally for some sort of fair value gap beneath the sell side liquidity. Now, another key tip with this, they don't have to be on the same time frame. For example, this could be on the weekly, and this fair value gap could be on the monthly. Okay, or this fair value gap could be on the this buy side liquidity could be on the daily, and the FVG could be on the H4. Okay. Number 2, right? This is seriously underlooked, right? I use this day in, day out. If you watch any of my other content, my weekly reviews, if you watch any sort of content I make, I use this every single day. Okay, and it's the idea of a previous candle's high or low. All right, and specifically we're going to look at the days, weeks, and months previous high and low. Okay, so when a candle prints, right, there are only 3 outcomes. Okay, you're either going to take the previous candle, so this being the previous candle here, you're either going to reach for the previous candle's high, you're either going to reach for the previous candle's low, you're going to have an in-bar day, which basically means we end up not taking previous candle's high or previous candle's low. In-bar day refers to these two being daily candles, so you could just call it an in-bar. And number 3 is we take both previous candles high and previous candles low. Okay, so these are the only 3 outcomes that are ever going to happen in price action, right? If we really strip it back, these are the only 3 possible scenarios. There's nothing else outside of this that can happen. Okay, now when we narrow down our focus, right, and what I ended up doing was, and you can do this practice as well, if you actually go in your charts and look at, out of one of these 3 scenarios, which one happens the most, you'll start to notice that one of these 3 things happen the majority of the time. I'd say around 70 to 80%. Okay, 2 of these only happen about 20% of the time, and the other one happens, I'd say around, I've done the numbers, but it's around 70 to 80% of the time, right? So you pause this video, have a think, which one do you think actually happens majority of the time? Okay, it's this one, right? So it's either that price reaches for PCH or PCL. And the interesting thing is that if we take one side of the market, it's actually quite unlikely that we're going to reach for the other. That's, again, you can go ahead, look at 100 candles and work out the percentages of the probability of us actually reaching for both sides of the candle. Okay, it does happen, so that's why I've put it there, and obviously it's possible. And of course, you would have seen that in price, but the most likely one is this one. Okay, a key tip with this one is typically when we get an in-bar candle, typically the next candle is very explosive. Okay, unless we're in a consolidation. And with this one, this profile normally happens on high impact news weeks, such as NFP, FOMC, CPI, PPI, those type of ones. Okay, so if we know, right, that the previous candle's high or low is going to get reached for, we can actually use this as an easy draw on liquidity. And you'll see again in my weekly reviews, I use this all the time. So let's say a new week's going to start. Let's just say this was the previous week's candle. We can actually use this idea to try and forecast whether, and you can put a sort of prediction on price to say, cool, do I think price is going to reach for previous candle's high? Or is price going to reach for previous candles low? And that can just be your first sort of draw on liquidity. And let's say that's on the weekly, then you can drop down to the daily, and you'd expect each daily candle to expand towards that previous candle's high. Okay. Now, don't worry if you're more of a visual learner. I'm pretty much a visual learner. I'm going to give examples later on, and I'm actually going to give some examples that you can go away and look at yourself. Okay. So another way that you can sort of use this idea is, again, looking at the drawn liquidity, but think about proximity. Okay, so for example, let's say this is let's just say this is the previous candle's high. Let's say this is the weekly candle, for example, and let's say that this candle is currently printing. It's not closed yet, but that's what it looks like right now. Or actually, do you know what, let's do this on the monthly, because I do this a lot on the monthly. Let's say that this is the previous monthly candle's high, previous monthly candle's low. Now we have this candle here, which again, like I said, has not been printed yet. It's forming. Let's say it has, I don't know, 15 days left for it to form. Now, where would you say, okay, in terms of PCH or PCL, which one is price likely to gravitate towards, just based on the idea of proximity? And if you don't understand what I mean by that, I just mean which is closest. I would lean towards PCL, of course, right? So you then could jump down on the daily and you can expect, let's say, some sort of PD rate to get hit, and then price to navigate its way down to the previous candle's low. Okay, there you go, right? So the answer would be previous candle's low. And like I said, you can think about this in terms of the daily, weekly, and monthly. Okay, specifically when we're doing this on the higher time frame, those are the 3 time frames I'm going to focus on predominantly. Number 3 is order flow. Let's just say program. There should be an R there. So order flow / program. Okay, and what you'd want to do is, and I do this all the time, I'm going to go on the monthly chart, the weekly chart, and the daily chart. Okay, and I'm going to try and understand where the order flow is going. Okay, and whether we're in a buy program, which basically means bullish raise being respected, high highs, high lows being made, or if we're in a sell program, which is vice versa. So in a buy program, price is going to seek old highs and bearish fair value gaps, and also bullish arrays such as old SIBIs are going to get used as IFEGs to support price to the upside. So the way you're going to use this essentially is, let's say, okay, for example, we knew price was bearish, or not bearish, sorry, we suggested the idea that price may go and seek previous candles low. Then you're going to look for bearish order flow. Okay, you're going to look for price to be in a sell program, and you're going to look for price to be respecting bearish arrays. Any old highs should act as total soup shorts. Okay, and you're going to look for price to then seek bullish fair value gaps underneath old lows, and those will be your drawn liquidity. Okay, another key thing to notice as well is that, and I feel like it's not really spoken about that much, a drawn liquidity isn't an area that has to be met. A drawn liquidity is simply where you believe price is gravitating towards in that particular session. Okay, if you didn't quite catch that, repeat the video. That is really, really important, because that actually shifts the goalpost a little bit, because people always think that their success is determined on where the drawn liquidity, if the drawn liquidity is tagged. But in actual fact, that is not the case whatsoever. It's more or less understanding or trying to gauge if the current session that you're trading in is going to seek or push towards your drawn liquidity. That's more important than anything. So invalidation zones and roadblocks. Now, everyone loves to bang on about bearish order flow and the idea that, let's say we're seeking, let's say this is previous week's low, or it is previous week's low, this is previous month's low. So let's just say my drawn liquidity is down, and I see that we've respected a bearish FVG here. Okay, it's very easy to say now that price should just roll over to this, right? I see this all online, this whole internal range to external range idea. Yes, it's valid, but you cannot just use that alone. It is not enough. Okay, what you need to understand here now is you need to understand what your invalidation zones are and what the roadblocks are. Okay, so let's start with roadblocks in this example. So if price wants to get from this level and I want to see price get down to here, this is my drawn liquidity, what areas are price going to struggle to get past? Okay, or what are the potential areas where price may reverse or may give some sort of retracement or just struggle to pretty much just get past, really. That's the question you want to ask yourself. And you want to limit these ideas down to typically just start with fair value gaps. Okay, that's the easiest way to think about it. You want to basically look at what FEGs are going to potentially stop price in its tracks and maybe give you some sort of resistance. And you want to be very, very careful around those zones, right? So in this example, again, pause the video, see if you can find it. The roadblock in this scenario would be this FVG. Okay, so this fair value gap here. So the way I would then navigate this is if I could find a trade up inside this level then I would be at break even once this FEG was to get met. Okay, that's one way of dealing with it. The second way of dealing with it is, let's say you couldn't find a trade up here. I'd wait for this area to get inverted, which basically means close through. Once that level is closed through, I will then use that on the other side of the market and then look for price to seek my drawn liquidity. So you have to be very, very careful around these roadblocks, because what can happen a lot of the time is price looks good, it's dropping, but sometimes this roadblock is either going to offer a reversal or it's going to offer a deeper retracement. So where you'd thought that bearish order flow should just continue us down to the previous week's low, the path of price may not be that simple. Okay, this is going to offer some sort of resistance most likely. So here you go. Obviously, I've mentioned it's roadblock. I'm not saying there's a roadblock in the sense that the PD array is called a roadblock. Of course, it's an FEG, but it's acting as a roadblock, right? And why is that? Okay, understand this is a 4-hour time frame. So let's say you were looking for shorts. Price has come into this level, and you can see it's spent a good almost 8 hours. I mean, maybe 5 hours, because let's say the first 3 hours of this candle was going lower. It spent a good 4 hours just banging around inside this level here, 4 or 5 hours. Now, that's bad, right? Because if we're looking for, let's say, New York session to roll over, you really need to understand, have we already tapped this level or not? Okay, so like I said, this level has in this case offered some sort of retracement, right? And I don't think I've included it, but this level actually ended up sending gold all the way up, back up here. So the key sort of point to this is that you need to be careful of these areas that are potentially going to stop price in its tracks or slow price down. If we're trading from here, like I said, from here to here, this is a good move, right? And understand that your drawn liquidity was down, price has respected a bearish array, and price has then gone and tapped the roadblock. So from here to here would actually have been a good trade. Let's say this was London session and you was able to capitalize on that. That's beautiful, because if you remember what I said earlier, defining a good drawn liquidity is understanding when or how price will navigate from one array to another inside of a session. Or sorry, not one array to another, but towards our drawn liquidity inside of a specific session. But like I said, when we get hit with the roadblock, we don't know now how far we're going to retrace away from this zone. Okay, so we have to be very, very, very careful with those. Okay, let's have a look at invalidation zones. So here we have a market maker buy model turn sell model, which is also a shift from a buy to a sell program, which is denoted by this level here, which is the change in state. We have a total soup here as well. Okay, so price tags that level. We're in a sell program here, bearish order flow. This order block here is holding. Now, in this scenario, my drawn liquidity is down. That's because we have bearish order flow, and again, it will be due to other factors such as the previous monthly candles low or previous monthly candles high, all that good stuff. So at this point in time, I want to see this collection of up candles navigate price to the downside. Now, the question you have to ask yourself is, what area, if traded to, will invalidate my bias? Okay, so what area, if we trade to that zone, will essentially mean my bias isn't valid anymore? Okay, and this is something that is not that it's subjective, but it is subjective because it will be down to your own study, right? It will be different for everyone. For me, I'd be looking at this zone here. Okay, so if we closed above this, then for me, I would be a bit more wary. I'd want to wait for more information, and potentially the zone, or sorry, this trade idea would be invalidated. Okay, for others, it will be this FEG. The reason why, and again, I'll give you the reason why. So the reason why this would be my invalidation area here is because then if we close above this, we would have validated this as a bullish order block. Okay, so bullish arrays would start to be forming. If we close through this FEG before, I would start to be wary, but that probably wouldn't be enough for me. I'd still be looking for potential shorts, but this would be the zone for me, right? Where we'd close through this FEG, we would have closed through this FEG, and we would have closed above here. So then my draw basically would become that high, and if we pretty much blast through that high, then I'd be looking for higher prices based on this sort of model, potentially switching from a sell model to a buy model. Okay, so that's my invalidation zone, but this is something that you're going to end up creating on your own, and every setup looks different with this as well. Okay, for example, you might have been looking to short initially inside of here. Now if that area becomes invalidated, you have to ask yourself, does that mean the whole idea is invalidated now? Okay, that is the key sort of question you have to ask yourself, and that is something that is unteachable. It will only be something where you'll practice, you'll see other people have their invalidation zones, and then you'll be able to form your own invalidation zones as well. And like I said, if you stick to the end, I'll give you a free Notion template where you can go ahead and do that. Number 5 is the weekly cycles. Okay, so these are 3 cycles that I use every single week in my trading. On the left you have a classic expansion, in the middle you have a midweek reversal, and on the right you have the consolidation reversal. So the classic expansion is basically when the high of the day is made at the start of the week, either Monday or Tuesday, and rides higher, ending off the week, creating the high. Okay, midweek reversal is when Wednesday is made low of week and Friday is made high, and consolidation reversal is when Thursday is made low of week and Friday essentially goes and impulses higher. So what you can do is you can actually look for these cycles in price. For example, let's say, right, we're anticipating previous month's high to get taken. Okay, let's say we're anticipating a bullish week to happen. You can let Monday play out. You can maybe notice that Tuesday expanded, and then on Wednesday, under the idea that I understand that we're inside of this weekly expansion profile, I can confidently trade Wednesday as an expansion. Okay, same with something like the midweek reversal. Let's say we come down here, we tap a higher time frame PD array on Wednesday, then and let's say we close bullish as well, right, sweeping some sort of liquidity as well and having some sort of inefficiency as target above price, then I can confidently trade maybe Thursday as an expansion. Okay, but what you want to go away and do is you want to write down both of these, all 3 of these weekly cycles. You actually want to look for them in price, number 1. But number 2, you actually want to figure out what days of these each individual cycle are high probability days to anticipate an expansion. Okay, number 6 is market maker models. So here we have it's a very sort of crude depiction, but we have original, consolidation, accumulation, smart money reversal, distribution, and redistribution. Okay, and the drawn liquidity is beneath us here. And for example, in this case where we're looking at a sell model, of course we're going to anticipate the redistribution to go and send price lower. Okay, now this might look a bit odd, like why have I just included market maker models here? The point I'm trying to get you guys to understand is you're going to use every single point that I've mentioned previous in this PowerPoint, and you're using them together to form a bias. So for example, you may have understood that the previous month's candle is present. You may then understand that the order flow is bearish, right? And then now on top of that, you may get the market maker model, and you may notice that we have a bearish market maker model. Okay, and then you're putting all these points together to go ahead and then form and be confident in your bias and your drawn liquidity. So what do you do once you've got the daily bias, or the bias as a whole? Okay, the answer to that is daily profiling, and that will be something that I will cover in a future video. But basically what that means is once you know where the day is likely to expand to, then you want to then study how does that day open up. What do we do in London? What do we do in New York? Okay, and now the key thing with this, and I think a lot of people go wrong with this, people think the same one profile happens all the time. Okay, I think it's now 7 or 8 profiles. Okay, and those are sort of my personal profiles I've tested over a long period of time and I've come up with, right? But this is key to understanding what's going on in price, right? It's good knowing the bias, but the next step to that is then profiling the price action inside of that daily candle, and I'll make future videos on that concept. So here's the Notion template. I'm going to click on that in a second. with the Notion template, read through it, have a look. But the key thing here, no one's going to tell you this, is you need to go away and you need to practice daily bias on your own with this template. Okay, and I'm going to give you some examples that I've used to do this, how I've done this, how I've gone about doing this in the past. These examples that I'm going to show you are real examples that I documented last year, where I was testing myself to see how good I was at that point in time with daily bias. And it's good to practice this, whether you want to practice it all year round, whether you want to practice it multiple times a year. It's just good to see how good you are at being able to sort of just read the bias, and then remember what I said, being able to have a draw on liquidity and then see your current session that you're trading gravitate towards that draw. That's how you want to define your success. It's if the current session that you're trading is propelling itself towards your draw on liquidity. It's not if your draw on liquidity gets hit. So just a quick one here on how to get the free Notion template. Click on free Discord and then click get access. It will take you to a page that looks similar to this, just without all the other stuff there, and you will see free Discord and free Notion template, and here you can just click here to get access to the link. It will look something like this. You'll literally just click here and it will open it up for you. So this is the template that you're going to end up getting. If you click these three lines here, click this, it will duplicate it to your own page, which you can then go and use this button and go and basically use this yourself. So the way I would do this, I'd put the date here, so the 3rd to the 7th of July. This was 2023, and if you click here, it just creates another one of these, and it's called bias. Okay, so inside of here, again, you will have access to this. You can go ahead, take this template and do whatever you want with it. Okay, so the green would resemble when I got it right, and the red would resemble when I got it wrong. Obviously, you can see I did all right here. Okay, so I'm not going to go through all of them. You can do that in your own time. I'm just going to look at the silver ones as they follow along quite nicely. So you can see my charts are a bit weird here. This is on Sunday, so this is before the week had started, right? So the candles are, in fact, static here. So I've written here before. This is before sort of the bias has played out, right? On a Sunday. Okay, and this is basically what I want to see. So I've written here, monthly institutional order flow is bullish. Weekly is down. However, we have hit a discount array. Swept previous week's low. And then you can see we have a failure swing. What time frame is this? Daily. Yep, so we swept a weekly low, and then you can see we have a failure swing here. Price is respecting a bullish order block, or the bullish order block. You can see here on this. So this is gold, right? We're looking at silver. You can see on gold we have some SMT divergence there as well. So that just enhances the idea too. So as you can see, price created the IFEG. The state was changed, on the 4 hour, shifting from what would be in a sell program to more of a buy program. And you can see here I've marked on the H for whether you view that as a mitigation block, order block. I probably wouldn't even define it as a mitigation block now. But yeah, it's essentially just a failure swing, and it's a change in state of delivery. I view that now as an order block, and I wanted to see price tap into the FEG and then extend to this high. Okay, so how did I come to that idea? Well, we had the SMT, the draw up here, right? If you understand, look, is what previous week's high. Okay, so you'll have to look through these and understand why I've done that. On the weekly, okay, we just tapped a discount array, and then we had an in-bar week. Okay, we didn't tap previous week's high or low. So in terms of proximity and just understanding what's happened here, where would I then anticipate price to draw towards? Well, here it will clearly be the previous week's high, and to couple that with a FEG, we can use the weekly FEG. So we're looking at previous week's high as the draw plus an FEG above it, and that's how I've come to that conclusion there, and that's essentially the draw on liquidity. So let's see what happens here. Okay, so price didn't reach the specific level, the two blue lines that I wanted, but it pushed off the 4-hour FEG that I have not marked here. We end up running out a low and pushing higher. And you can see how, so this is Asia, this is London, this is New York. See how Asia swept, then continued higher and diverged with gold, and this is why we don't reach the desired target. So what actually happened is on gold we did actually reach for this level, but on silver we didn't. And then you can see overnight, right, we actually do tap into the exact level that I wanted and expand to the upside. So let's have a look at another one of these. Okay, so carrying it on, right? Same drawn liquidity. Remember, this is previous week's high. This is now looking at Tuesday. So we had Monday, we had Tuesday. Okay, so this is before. This was, this would have been in the morning. This is before. So this was overnight. We tapped that level. Now I want to anticipate this daily candle to go and reach for the previous day's high and the previous week's high. Again, silver's target got reached yesterday, so down here. Okay, so in terms of an array, where do I want to see price expand from? Well, we have a turtle soup here. If we ignore this wick for a second, and we have a order block here. So Asia taken, then displacement higher, OB formed, which should launch price higher, and I've talked about a potential OTE that lines up with the daily open. Okay, and then you can see this is after in the same day, and this is in between London and New York, and you can always see the timestamps here if you don't understand, and you can see we got that perfectly. We tapped into the OTE as anticipated, and we rose higher. Okay. So lastly, let's check now what happened on Wednesday. So the before, which this was the screenshot from the first case study. This is on the second. Okay, monthly bullish. I've just reiterated it. Weekly was down, but we have to hit a discount rate. So I've just copy and pasted some of this over. Again, we wanted to see previous week's high being tagged. The failure swing was present. The SMT was present. And now, okay, I wanted to see this breaker, and I was using this as equal lows, ignoring this wick. I wanted to see these equal lows swept out, and I wanted to see the breaker support price to go higher. Why is that a breaker? So a low, high, and a low, which was closed above. So breaker there. And also this is a market maker buy model. Also we've got bullish order flow. We're incorporating the idea of FEG plus liquidity as the draw. So you can see how everything that I've mentioned from the PowerPoint I'm using together so that you can actually use all these principles to forecast where the daily bias is. So in this example, we want to see the current daily candle expand higher. Let's have a look what happened. So I didn't write after, but anyway, you can see beautiful delivery to the upside, and the drawn liquidity was tagged nicely. Okay, so that ends off the video. If you guys want to check out any of these, then look for the link in the description. You will get access to the Notion template where you can go ahead and do this yourself, right? So when you click this template link here, it will create one of these, and then you can go ahead just like I have and see how well you can forecast the daily bias. The other thing as well is you can look at all these other examples and check out, for example, when I got it wrong and the other essential case studies that I've put here. If you enjoyed my free content and wanted to get access to a bit more, then check out my two packages. We have the complete package, which includes 6 courses, advanced technical course. You can also see the titles of each course inside of this picture here. I talk about how to frame the daily inside of here as well, and a ton of more, or a ton of different stuff, right? I believe that the traders need a holistic approach. We need points from all different avenues in order to get us to profitability. There's a template in the group chat, and then also you'd get 30 days of free mentorship, free access to the monthly mentorship, which includes a weekly call, the vault, and a premium outlook, the vault being a place where I basically produce new content and put it there every month, including breakdowns and private call recordings, plus the premium outlook, which is where, if you haven't seen already, I essentially give out daily biases. I give out price step by step, walking through candle by candle down to sometimes the 1 minute, looking at where I want to see that current session expand. So I hope you guys got some value out of this. If you did, drop some love below, drop some comments. Let me know if there's anything you want to add here, any key tips that you like to use. And yeah, we'll see you guys in the next video.